Welcome to the daily update, where I'll go over the action in the market for Monday, March 31st, and we'll see how things look for Tuesday, April 1st. Happy new month. Happy April Fool's Day. Well, we saw a pretty impressive little bounce in Monday's session. Now, some of this could have been due to the fact that it was the last day of the month, the last day of the quarter. There could have been some window dressing going on. We ended up opening quite negative and then made our way back and closed positive, but we're not seeing an awful lot of improvement with our charts. I'll go through and show you. There's some subtle little changes here, but growth didn't really have that good of a day compared to value, and the mega caps really underperformed. We saw more of the rest of the stocks in the S&P 500 that are now participating. We'll see, is that going to shift? We do have some positive seasonality for Tuesday, the first day of the month. So we'll see if things can shift over and look a little more positive. All right. So right at the open, we did have a gap lower open below S1 at 55.40. Prices found support at S2, which is right at 5,500. So we had a round number lining up with a pivot point, which is not all that unusual. That's why I really stress the idea of go to the YouTube community tab. I have charts, the two charts that I update every day, and you can follow along. You know these numbers before the market even opens, and that can be really helpful. And then right after the open is when we set the intraday low. Then we started this steady climb back. We got back above S1. We got back above 5,600. We went positive by going above the unchanged level. We hit resistance at the daily pivot, another line that we knew about before Monday's session at 56.13. And then we ended up closing at the intraday high. We were up 0.55% on above average volume. Some of that could be institutions in buying and selling to do some end of the quarter type maneuvering. And we're still negative in the short and intermediate term. We're mixed in the long term. Interest rates were a little changed. They actually ticked down a little bit there. But all this has to do with these tariffs. They're starting to really come in and take effect. We have some coming in on April 2nd, some on April 3rd, and the market is really unsettled about that. So there was a lower open due to hesitation about Wednesday's implementation of these reciprocal tariffs and concern that, okay, now President Trump came out and said, well, we just might have to have a 20% universal tariffs on everything that we get from other countries. And that's enough to freak out even more the people that have already been freaked out, the folks that don't like him. And the folks that even do like him, it's like, okay, I'm getting a little nervous about what's happening here. Let's really hope this thing works. All right, we're still well below the 20 period moving average. That turned us back negative in the short term. And mega caps and growth just didn't really have a good day. We have the SPX EW, that's the equal weight version of the S&P. It held up better. It actually was up more on a percentage basis. We're still above 20 with the VIX coming in at 22.28. We're far away from the 20 period moving average as measured by the boom indicator and the intermediate term trend 50 period moving average. And the Arun finally woke up and said, okay, I'm going to go negative even more now. And it's extreme negative. We still have this non-confirmed Hindenburg Omen. Now, March 31st is the deadline, but there's a 1 day lag with the how that chart is updated. So we really won't know until after Tuesday's close if we had another spike. And if we don't, then this Hindenburg Omen falls off the books and just kind of goes away. No change to the overall scenario with the Fed. And the dollar was up, interest rates were down. We closed at 4.25% with the 10-year yield, where after Friday we were at 4.26%. We're still extreme negative with sentiment, even though we clawed our way back and had a positive close. We ticked down from 22 to 21 as far as sentiment. The 10 to the 3 month yield curve is still inverted, and we're still negative as far as the ADX. The red line's above the green line. It's trying to turn back up and maybe possibly get back above its moving average, but it hasn't done that yet. And because we had an up day, but things are not really looking good internally as far as Monday's action, I have the bias at mixed. there were some good things and there were some not so good things. So together, it's kind of a wash. And I'm still keeping our momentum at negative. So we just had the Chicago PMI come out. The takeaway from this is that the number's under 50, and that's showing contraction, but it did come in stronger than they had expected at 47.6, and also up from the reading of 45 that came out last time. No charts to show you there. This is saying the Goldman Sachs says that the 3 month return they expected to be down 5%, but 12 months going out, we're going to be up 6%. So then also plotted on here are earnings, and they're still projecting them to go up moving forward as they think we're still going to fall here with the price of the S&P before we go up. And 12 months from now, we'll be at 5,900. Okay. Then there's another sentiment gauge coming in pretty low now, not as low as it was before, but this just shows the pessimism that's in the market currently. Equity positioning still falling under the zero level, even though it bounced up just a little bit from the previous reading. The forward-looking PE ratio, when you take it all together, we are between 20 and 21. This chart shows it coming in at 21, where if you take the equal weight version, it's more fairly priced, coming in at 16. And then you have this discretionary method where folks may try to time the market more. And that tends to do better when the market's going down. Where if you have a systematic approach, you just, you're not really paying attention to what's going on in the market. You just have this system that you follow that tends to underperform. That's the dark blue line when we're having more difficulties in the market. No real change here with the recession probabilities. Just kind of chopping along. We're not at the black line, let alone the red line yet. Then this is just showing if you base things around how people are feeling, that's the green line, and they're pretty pessimistic. But if you look at the actual data that's coming out, it's actually not looking too bad. So a lot of this is more emotionally driven. Also, these are the earnings revisions, and they have been coming down. Even though they're still positive looking out, they're coming down with those the higher estimates to lower estimates, but they're still positive. And then under our new tariff baseline, year on year core PCE inflation, they think inflation is going to go up to 3.5%. If we didn't have any tariffs at all, they think we'd get down to this 2% level. Okay, well, they've been hoping for that for quite a while, and it's just never happened. But then the actual is where we're at now. That's over on the left-hand side. Then they have this blue dashed baseline by Goldman Sachs, and then the previous baseline here. Not really all that much of a change, but it's enough for people that like what's going on to say it doesn't look that bad. People that don't like what's going on right now, oh, it's destroying the economy. Everything's falling off a cliff. All right, so here's the chart, and we did gap lower. The futures were negative pretty much when they opened Sunday evening and just kept going down, and that produced this gap lower open. But then within just 20 minutes of the market opening, we set the low right down here at S2, and then we just clawed our way back. We got back above S1, we got above the unchanged level all the way up to the daily pivot, and boom, that's where we closed. That's why I really stress looking at the pivot point charts that I post on the YouTube community tab because these numbers are known before the market even opens. And if you can use these as a guide, that might be really helpful to you. And here's the intraday chart here where we were really dropping off with the futures, but then we made our comeback going into the close and we're down in the initial overnight session. This is one of the negative parts that really hasn't improved, even though both the red line and the blue line went up. We want the blue line to be above the red line, showing the growth is outperforming value. A little bit of an improvement here, but it was still negative when we look at S&P growth to value. End of day growth was up, but quite a bit less than value. It was up less for the mid caps, and it was actually up more for the small caps. So not really seeing much of an improvement here with our growth to value ratios. Small caps still showing weakness, mid cap showing weakness, S&P showing weakness. The growth to value ETFs showing more weakness here. So to be up and to see the nice little bounce that we saw we're not really seeing much improvement on an end of day basis here. And the discretionary to staples ratio continues to decline. This is where we're possibly starting to turn back up with the ADX, but we haven't crossed above the moving average. If we do continue to go up, that means the trend is now getting stronger. When it's below the moving average, it's getting weaker, but it's negative. And the red line, even though we had an up day, the red line's going up and the green line's going down. Not any real improvement with this chart. Also turning up in the short term, not above the moving average yet. The red line's going up, the green line's going down. That's still more negative. And we were above average with volume as shown right here. The first green that we've seen, this was options expiration over a week ago. But all the other trading days were below average. And again, this could have been due to the being the last day of the month and quarter. Sentiment is more neutral according to this more composite chart that we look at coming in at 52.16. And we're getting a little more bearish now with the legal insider transactions. This red line going up, and that tends to mean things are more negative. We're back above 20 and climbing with the VIX, both with the line chart and the bar chart. And the VIX of the VIX, since we ended up coming back up and seeing a nice intraday bounce, the VIX of the VIX actually is coming down below its moving average. And the MACD is starting to turn up, but it's still showing that overall the momentum is down, but possibly getting ready to change. And we declined with this fear gauge, and we declined a little bit here, barely hard, barely recognizable there with this other fear gauge. So a little bit of confirmation there. We're continuing to decline with our risk on versus risk off ratio. That's more negative. When this is going down, in a more positive environment, we would see this ratio going up. And we're continuing to decline here with the spread between risky and not as risky bonds. That's a concern to us as we watch this fall. That means fear is increasing in the bond market. We decline with the equity put call ratio, but we're still going up with the 5-day chart, and we're barely ticking up here with the 10-day chart, which that tends to be leaning more to the negative side. We're turning up, but still below the band with our volatility risk premium and still holding up good here. And I pointed this out in numerous videos over the weekend. The advanced decline line based on price and volume still holding up for the most part. We're dropping a little bit below zero with the advanced decline over the last 10 periods here, but we've been just dancing either above or below the zero line for quite some time, going back to the early to middle part of February. Rolling over a bit here, we really saw an expansion of the new lows. When we had that lower open, that kicked in a lot of new 52-week lows. And then as we were clawing our way back, we ended up getting some new 52-week highs. But we're rolling over with the 5-day chart and starting to go down with the 10-day moving average chart. We're still above the moving average here with accumulation distribution. That actually showed some improvement. We're coming a little bit back above the midpoint with our short and intermediate term advanced decline ratio. An improvement here, barely trying to turn up here with the red line with the chicken money flow, smart money indicator number 2, and bouncing up, but still below the moving average with the chicken oscillator. Still negative with the vortex with the red line above the green line, and barely crossing back above 50 with those stocks inside the S&P above their 20 period moving averages, and still below 50 with the 50 period moving average study, 100 period moving average study, and 200 period moving average study. And a little bit of an improvement here with the advanced decline line based on a different length moving average here. We're coming right back up to the moving average where the NYSE common stock, mid caps, and small caps are still below the moving average. We were It was nice to see above average volume, but it's probably due to the end of the quarter here. Not really anything to hold on to with the daily chart here. We've got the new pivot points that are now being drawn in for the month of April. A little bit of an improvement, but we've just been chopping around here with the 20, 50, and 200-day moving averages. A little bit above the midpoint with Stochk RSI. A little bit under the midpoint with the Williams percent R. Not quite extreme negative with the CCI 14 or the CCI 20. The stochastics kind of chopping around the midpoint, still declining in the intermediate term, rolling over a bit here with the long term, but nothing is extreme positive or negative currently. Still negative with the force index, improved slightly. And we were looking better here with the condition of the short-term trend. Now, even though this is a green bar, this is not really good looking right now. We are seeing a kind of short term over the last number of days, a series of lower highs and lower lows, and the lines are starting to roll back over as well. And we're still in the -2 standard deviations trend channel. And we were getting kind of close to that 10% level on a closing basis from the all-time high. We closed at 8.66% after Monday. So we're still kind of in that area. And I'm measuring it here. Now, this is an intraday measurement from the intraday high set in February to the intraday low. Notice how we're coming right back down to this level. In a more positive environment, we would come down here and then just shoot up out of this and then get further away from it, similar to what we saw last August. We hit this level and then bounced up out of it. Now we're coming back down and testing it again. And still slightly positive with the balance of power above the midpoint. We're negative with the go, no go with the deep purple bars here. And a little bit of a bounce, but still below the midpoint with the highest high, lowest low value chart. TTM squeeze keeps going up though. It has the lighter shade of red and it's continuing to go up. And we're still initially extreme here with the rate of change going back 50 periods. We haven't bounced back up out of that at least yet. And we're just a little bit above the moving average with standard deviation, as we've been seeing things move rather quickly lately. Still negative with the ease of movement and it actually turned down. This is the Arun getting down to an extreme negative reading. That just means we're extreme with sellers and that there's a real lack of buyers, which when we get to an extreme reading could mean, okay, maybe we're about ready for a change. But we've been seeing a lot of different indicators that suggest we're washed out to the downside. Doesn't seem to matter. We might have a day or two that look pretty good, and then we're right back down there again. And we're just barely above the midpoint with the S&P McClellan oscillator. So we're starting to go down with the summation index based on price. We've already been declining based on volume. Actually, this is turning back up just a little bit. It's really hard to see with those little dots there. And we're still below zero with the NYSE McClellan oscillator. So we're going down with the summation index based on price for the and volume for the NYSE. Swell trading oscillator continues to decline. That's negative. Momentum is starting to roll over with the PMO, rolling over based on price and volume. And just kind of chopping around with the PMOs that are rising, starting to turn up just a little bit with the buy signals, but still flat with the PMOs that are above zero. Negative with the Elder's Impulse system for the S&P, negative with the parabolic SAR, and coming back above this red line, still positive here on a momentum basis with our short-term slope oscillator. Rolling back over again, though, is the MACD, but it's still above its moving average. And so the short term is looking better with the slope, rolling over a bit with the TSI. We're seeing more weakness coming in to our three intermediate term indicators, but we're still looking more positive with the long term oscillators. The copy curve is still positive, and the condition of the 50 period moving average trend, intermediate term, still coming down here. Didn't really get a chance to get above these lines below all the plotted moving averages. Now we did open at the low, or open and then went down and then closed off of the low at the intraday high. That's pretty positive, but how these bars are looking when taken together is not all that great looking. We're still far away from the 20 period and 50 period moving averages as measured by the boom indicator and ticking up, but still rather negative with the Sean trend meter. We're below 50 with the money flow, slightly above 50 with the ultimate oscillator, still above the moving average with on balance volume, still below 50 with the RSI 14 and 9. And we're still waiting for this line to come down to this red dash line. That would be the third criteria that's met, signaling that there could be a reversal according to the mass index. And we did have a buy signal triggered after Friday with the praying bottom fisher. Now, I wouldn't use these charts independently and make all my decisions around it, but this is now producing a buy signal with the mass index close to generating a buy signal. And we saw some real weakness here with the bullish percent index. It ended up coming down. It is now negative, even more negative, and the NYSE bullish percent index is declining, and we're really going down with the NASDAQ 100 bullish percent index. And we came up into the mini rainbow here. That's about as high as we got, and now we've been falling back down. That the lower end of this actually acted as overhead resistance here, and we fell down under the 50% retracement level, but we were able to come back up and get back above that by the time we closed. And we did fall down below the pivot point here, but we're still above it. This is at 55.75, this P right here. We closed at 56.11, so that bought us a little bit more room. We had 5 or 6 points after Friday of room left. And so since we went up, that buys us a little more room above this long-term support. And still looking negative with the Heiken Ashi. We're negative with the Kegi chart, red and pointing down. We're still positive here with the Renko chart, and we're positive again with the three-line break. It's picking up some of that bounce that we saw intraday, and it likes that. We did see a lower open, and as we went down, that drew in two red circles. That's negative. And now we have a pattern that's being recognized, a descending triple bottom breakdown. Ooh, yeah. Sounds like an interesting dance. All right, and we're still below the midpoint with the 150 and 200 period moving averages. And we're still looking rather the same here, where we're negative in the short and intermediate term with the indexes, but now we're looking long-term negative with the small caps. They just did not live up to any kind of expectation that was hoped for back in December. And bonds are still positive in the short term. They've now become positive in the intermediate term, but long term, they're looking negative. Commodities, and this is where a lot of the inflation fears are coming from. The CRB index is in an uptrend on all different time frames. Still seeing some weakness in the dollar in the short and intermediate term. And all the sectors ended up being up. But look at what was up the least. Tech, discretionary, communication was up 0.75%. But these are the three big growth areas. The areas that were strong, staples. Now it's good that financials are doing well. Utilities, energy. These are defensive areas. And even healthcare was up over 1%. So we're seeing more participation right now. Maybe it's some of these big institutions going in and buying some of these value stocks so they can put that into their quarterly report. And they're not getting into the growth stocks because they've been really suffering in 2025. And started off seeing lots of red. We had the tech sector giving us a 50-20 crossover. That's a death cross. And that's what I use as the basis for the trend as well. And then we had tech having a BPI cross below 20. So two negative things ended up happening. Staples had a bullish MACD crossover. That's actually negative because staples are defensive. And then we had this countdown here with the NASDAQ going below 17.3, 2, 1, blast off. Then it actually went down more below 16.9. And then healthcare had a BPI cross below 50, which could be a little more positive since that's defensive. But we're seeing strength with the utilities with a bullish MACD crossover. Real estate, another potentially defensive area. We had a BPI cross above 50. We got back above 5,600 with the S&P. Real estate, which has really been suffering also had a bullish MACD crossover. And then the Dow was able to get back above 42,000. And the Dow coming right up to its 200-day moving average. That's now acting as overhead resistance. We're still negative with the Elder's Impulse system for the diamonds. And the NASDAQ closed well off of its lows, but just not looking all that good. It clawed its way back, but it still ended up closing lower. And then one thing I neglected to point out, when we were coming back up, we hit the underside of the 200-day moving average with the NASDAQ 100, and then that's when we started to go down. So this is showing, at least for the NASDAQ 100, that this is overhead resistance. If we start to get back up to the 200-day moving average for the S&P, we'll be watching for that as well. And we're negative with the Qs when looking at the Elder's Impulse system. The momentum is barely positive, but rolling over for the NASDAQ 100. Small caps just not looking good. Death cross going down. They did bounce up a little bit and they were off the lows, but just not doing all that well. And then we look at the Russell 2000 small caps below 50 and declining with the RSI. Recent death cross rolling over with the momentum. Negative with the small cap index, according to the Elders Impulse system. Just getting ready for a death cross here with the mid caps. Negative with the Elders Impulse system for the mid caps. Still well below the 200-day moving average with the Wilshire, and also below the 200-day moving average with the total US stock ETF. Spiking back up here. To have an update like we saw and to see the spike go up, that's negative. That means staples are outperforming tech. And little bit of an improvement here, getting a little bit closer to the 50-day moving average with the financial sector. And that's a good thing if that still stays strong. The FANG index still falling further below its 200-day moving average. Apple was up 1.94% and getting really close to a death cross here. We were down 1.28% with Amazon, falling further below its 200-day moving average. Microsoft, which has already been in a downtrend, was down 0.9%. Google was up 0.2%, still below its 200-day moving average. Meta, which is one of the better looking charts lately, it's right about at its 200-day moving average. Nvidia starting to see a death cross here, down 1.18%. Tesla down below its 200-day moving average, down 1.67%. Netflix, another probably one of the better looking charts now, is was virtually unchanged, but down slightly and is a little bit below its 50-day moving average. And still kind of not really seeing a lot of change here with the correlation between US and world stocks, where you can see here, we're coming down here with the world bouncing back up. Now there's a 1 day lag with this chart too. So this doesn't account for Monday's action. And we're still trailing off for the most part with the longer term correlation between US and world stocks. Oil did climb back up into the low 70s, and the dollar was up, but still below its 200-day moving average. We look at interest rates, we were down with the 10-year yield. We were up with the 10-year based on price. We're inverted here with the 10 to the 3-month yield curve, just watching that for now. And no real improvement here with our growth to value ratios. Still going down with the Qs to S&P, discretionary to S&P, and large cap growth versus large cap value. So the large caps, mid caps, and small caps showing weakness with the growth to value ratios. Not what you would see in a positive environment. Still going down here with this ratio, meaning that the S&P is underperforming utilities, and we're spiking back up with the staples to S&P ratio. That's also more negative. That's showing that the market's becoming more defensive, meaning that at least this may not happen, but a lot of money managers out there are thinking we're going to go down, and so they're positioning themselves more defensively. So what's our outlook then for Tuesday? We're still negative in the short and intermediate term. We're mixed in the long term. We're still above that long-term support level. We were under it, but by the time we closed, we got back above it. I didn't update this. I'll show it on the next chart here. And then all the different geopolitical things that are happening. We're going to get the S&P Global Manufacturing PMI, construction spending. The big one's going to be the ISM manufacturing. And then since this is jobs week, we're going to get the JOLTS job openings report. Later in the week, we'll be getting the ADP employment change. We're going to get ISM services or non-manufacturing on Thursday. And then the big one is going to be on Friday. We'll see how the employment situation is holding up. Here's a look at the different reports that will be released on Tuesday. Seasonally, it is positive, which is kind of common for the first day of the month. Folks are deploying new capital. We're positive with the Dow, S&P, and NASDAQ. Now, since we're starting over into April, I'm keeping this on here because January was up, and whatever January does, by the time we finish out the year, at least with a high percentage, 83.8% of the time, that's how the year ends up finishing out. But the best 6 months of the year, after we finish with April, that 6 months window is now gone. So going over the last 75 years, we're up 71% of the time in April and down 29%. So fairly positive. And then I'll deal with options expiration as we get closer to that in the middle of April. So looking here, now it depends on how you look at this. If you look at the solid line, we have positive seasonality. But if you look at the post-election data, it's actually more negative. So a little bit of a contradiction there. So the warning signs, the accumulation distribution went up and it's positive. We're showing some improvement with the Chaikin money flow and the Chaikin oscillator, but they're still negative taken together. The NYSE, McClellan Oscillator, and Summation Index are now negative, where the S&P is still positive. Swindler Trading Oscillator is still going down. The Parabolic SAR is negative. The bullish percent indexes are negative, and our moving average studies, every one of them is below 50. These movement and the money flow are also negative, and the vortex is negative. And then the long-term oscillator called the Special K that continues to be negative. And then the positive things are we still have a longer term uptrend with growth to value, discretionary to staples. But so far in 2025, it's been pretty dismal and actually negative. Here's where the S&P McClellan Oscillator and Summation Index, they are positive. And we're still looking positive with our oscillators, although they are rolling over to a degree. Copy curve is still positive. The financial sector is positive, but we're still below the 200-day moving average with the bank ETF. The ultimate oscillator is positive, and we're still hanging on to barely being positive with the momentum for the NASDAQ 100. It's weakening. So our conclusion, we're negative in the short and intermediate term, where we're mixed with the long term. And in the short, there's really not much to show that we're oversold right now. We're just flat out negative, both in the short and intermediate term. And we're mixed in the long term because we're below the 200-day simple moving average, but the trend is still positive. Thank you. I hope you found this helpful. Have a really good day on Tuesday, and I will talk to you in the next video.